Good afternoon, everybody, and thank you for being with us today. My name is Ferdinando Nelli Feroci. I am the president of the Istituto Affari Internazionali, and I am pleased to welcome you on behalf of the Istituto to this online meeting. Today, we present and discuss a recently published book, The Near Future of Central Bank Digital Currencies, Risks and Opportunities for the Global Economy and Societies, which has been edited by the two researchers of our institute, Nicola Bilotta and Fabrizio Botti, and with the scientific coordination of Franco Passacantando. First of all, I would like to thank the Deputy Governor of the Bank of Italy, Mr. Piero Cipollone, who will be with us and will speak in a moment, and Mr. Mauro Micillo, Chief of IMI Corporate and Investment Banking Division at Intesa Sanpaolo. But I would also like to thank all other discussants of our seminar who have contributed to this book with separate chapters of the book. The webinar today and the volume we're presenting are the results of a research project which has been carried out in the framework of a partnership between the Istituto Affari Internazionali and Banca Intesa Sanpaolo with the support of Banca d'Italia, Bank of Italy. Now, digitalization has been changing the way how people use money, with the result of a global significant reduction of the share of cash in transaction in favor of cards and e-money solutions. Digital currencies and digital currencies platforms are becoming, in these very days, the subject of growing interest by the media, by the way. And in this context, growing digitalization of payments, the discussion around the introduction of a retail central bank digital currency, CBDC has also gained momentum. According to a survey conducted by the Bank for International Settlements, something like 86% of the worldwide central banks are actively researching the potential of digital currencies. 60% were experimenting with the technology already, and 14% are deploying pilot projects on digital currencies. So central bank digital currencies could produce great efficiency gains, could encourage contestability in payment systems and foster financial inclusion. Nevertheless, benefits often come together with new risks, which need to be addressed by central banks, such as, by the way, for instance, the consequences of potential disintermediation in the financial industry or the operational and security challenges they could produce. Moreover, there are also concerns related to privacy in CBDC systems, as well as questions on how national central bank digital currencies could impact cross-border transactions and international monetary system as a whole. Not to mention, if I may add, the very concrete risk that central bank digital currencies may become one more element of global competition. I have in mind, in particular, competition between the US and China. To sum up, the development of central bank digital currencies give rise to several implications which go beyond the boundaries of the payment market, potentially transforming at the core our economy and society. So to shed some lights on at least some of the potential effects, risks and benefits around the development of CBDCs, the Institute has carried out this research, mobilizing a very qualified and diversified group of international experts who for more than a year have exchanged their views and research on different aspects of this innovation. And by the way, have also contributed with the several chapters of the book that we are presenting today. So I'm conclude this very short presentation before giving the floor to Mr. Micillo, let me thank once more, in particular, Nicola Vilotta and Fabrizio Botti, and of course, Franco Passacantando for their contribution to this work. Thank you, and Mr. Micillo, the floor is yours.
Thank you so much. It's a great pleasure for me. First of all, I'd like to thank the IAI, so the Istituto Affari Internazionali, the Bank of Italy, the authors of the volume, and the audience, including esteemed delegates from the foreign embassies and Italian institutions. In 2017, Intesa Sanpaolo and IAI started a multi-year partnership aimed at developing innovative research activities, in particular with respect to the relationship of mutual influence between the financial and policy-making world. Intesa Sanpaolo has been proudly working with both the Bank of Italy and IAI for several years in the field of Central Bank Digital Currencies, CBDCs, and is fully committed to providing resources and competencies in order to properly address future development, cooperating with Italian and international institutions. As a matter of fact, we have participated in several consultations and working groups on digital currencies promoted by the Financial Stability Board and the ECB, both directly and through industry associations such as the European Banking Federation and the Italian Banking Association. The increasing innovations in technology and new consumer preferences have fundamentally changed the payments industry. The presence of global private players in the large digital payments ecosystem has contributed to central banks seeking solutions to the threats that private digital currencies pose to the implementation of monetary policy and to financial stability. CBDCs projects have accelerated, and nowadays more than 50 central banks are working on CBDCs. Within this framework, Fabio Panetta, member of the executive board of the ECB with a mandate on digital topics, has recently stated that the ECB should decide whether to start an analysis regarding the possibility of the introduction of a digital euro. This initial phase should be dedicated to assessing possible setups and user requirements, and also the condition according to which financial intermediaries could provide front-end services based on the digital euro. The analysis will probably take a couple of years. Eventually, the ECB Governing Council should decide whether or not to introduce the digital euro and how to structure it. Let me also mention that I want to specifically discuss cryptocurrency here. They are generating enormous interest among investors. Take, for example, last week, Nasdaq IPO for Coinbase, a US cryptocurrency exchange platform that at the first close had a market cap of approximately $65 billion, rivaling that of the New York Stock Exchange parent company, which is worth around $76 billion. But let's talk 1 second about the opportunities potentially linked to CBDCs that are in certain cases similar to those related to other electronic payment systems. As argued by the general manager of the BIS, CBDCs constitute a technologically advanced representation of central bank money, and if well designed, could offer secure, neutral, and definitive means of settlement for the digital economy. Some of the main opportunities that we see are, first, cross-border payment, reducing transaction costs. Second, financial inclusion of unbanked segments of society exposed to non-state-of-the-art payments and banking systems. And third, value-added services that commercial banks can offer on top of basic CBDCs to their customers, such as post-trading, consultancy, commercial offers, digital administrations, loyalty programs, and mobility service. But for sure, we believe that attention must be paid to some critical issues, some threats, such as, firstly, the management of a CBDC system carries for central banks governance, operational, and reputational implications. An increase in the complexity of the system and the number of its users could bring about higher risk of an operational failure and a consequent reputational impact. Secondly, in case central banks decided to directly issue digital currency without leaning on financial intermediaries, we could witness a disintermediation of banks, which could be really painful because of reduced source of funding for banks and reduced credit firepower, and an increase in cost of funding and increase of cost for clients. In this scenario, however, we believe that a few mitigation factors could be envisaged, such as the introduction of thresholds for CBDC health to keep the system balanced. Furthermore, regarding these risks, it's worth mentioning that Fabio Panetta, in his speech to the members of the European Parliament, underlined that a digital euro would only complement cash, not replacing it, and the digital euro would not crowd out banks. And then we have a problem regarding AML and privacy, which is, again, another threat that should be addressed. Few words regarding Intesa Sanpaolo expertise on digital currencies development. In 2017, Intesa Sanpaolo, under the supervision of the Bank of Italy, started the proof of concept on the so-called virtual euro to test the feasibility of a value-based digital currency privately issued and euro-backed with a convertibility ratio of 1:1. We focused on digital euro as a payment instrument in a real end-to-end experiment. Let me summarize some of the lessons learned. A digital euro on the condition of 100% collateral would make monetary control highly practicable by central banks. Secondly, the creation of a technical, administrative, and legal framework is achievable under the current European framework, but it would require significant investments and a systemic adoption backed by all the European institutions. Institutions have made, in my opinion, great steps ahead in this field, as confirmed by the results of the public consultation recently finalized, which were described by the ECB Executive Board member Fabio Panetta as encouraging, and which confirmed the willingness of citizens and professionals to support the digital euro. We are fully committed to cooperating with the ECB during the investigation phase on a digital euro that is about to start. Few words regarding Intesa Sanpaolo initiatives in the digital field. The activities carried out on CBDCs area are part of a wider framework of initiatives linked to the digital transformation, in which Intesa Sanpaolo has been investing over the last few years, as you know, as one of the key pillars of our strategic business plan. Furthermore, I would also like to point out how our bank promptly reacted to the pandemic last year, providing our clients with useful instruments to face the crisis, increasing the already available innovative and digital processes to ensure business continuity. In this regard, let me just briefly mention some of the most significant initiatives which the IMI Corporate Investment Banking Division, which I'm very proud of having, has undertaken. We have developed our global web banking platform named InBits, specifically designed to enable corporate clients to access a centralized and digital control system for global transaction products. Moreover, in the second half of this year, we are planning to launch a new digital platform for financial institutions, which will benefit of a single access point, a sort of one-stop shop, where to find research, market data, and trade execution on several products and asset classes. At the same time, we keep an ongoing dialogue with industry leaders and fintech companies to pick emerging revolutionary ideas that may have a material impact on technologies and processes for the financial system, as our head of innovation, Paola Papanicolaou, will discuss during her closing remarks. I will see the future. In conclusion, I will try to summarize some of the issues that will have to be addressed. CBDCs pose legal issues in relation to tax, property, privacy, data protection laws, anti-money laundering, and countering terrorist financing. The coexistence of both private digital currencies and those issued by central banks highlights the need for a global regulatory framework, besides related requirements and standards to ensure that all these initiatives lead to an improvement in financial inclusion, security, and consumer protection, as well as efficiency in domestic and cross-border payments. In this sense, further structuring an international network of regulators on CBDCs could play a role in reducing fragmentation and supporting growth in the global economy. In the near future, we see opportunity for an increased dialogue and a greater involvement of commercial banks in the working group led by relevant authorities, a deeper monitoring by all actors of what is happening in other relevant jurisdictions, and ongoing analysis of potential scenarios by commercial banks and systemic approach by regulators to what is happening to our interests. Whatever the decision, it should be based on a deep impact analysis considering both the emerging cost of introducing digital euro, as well as the potential impairment of investments that financial institutions have made to create a fast, secure, and reliable payment system according to the current regulatory framework. On behalf of Intesa Sanpaolo, let me once again thank the organizer of this very timely event and publication. I look forward to our debate. Thank you so much.
Thank you very much, Mr. Micillo. And now the floor is for Mr. Piero Cipollone.
Thank you very much. Let me thank the organizer for inviting me to this seminar. I've read all the chapters of the book that will be discussed today, and I find them very interesting and useful. Before entering the core of my presentation, let me make two initial remarks. My initial remark is on the title of this interesting seminar. A year ago, this title would have been perfect. Today, I guess, is a little bit out of the date. Why? Because the parentheses around the word near are no longer warranted. Why such? Because in the last year, the discussion on CBDC has accelerated in an unprecedented manner. It was yesterday that Bank of England and the UK Treasury announced that the creation of a CBDC task force. So this seminar is very timely, and indeed the future of the Central Bank Digital Currencies are really near. My second observation is that the book is very rich of perspectives and points out to the many questions that need to be answered before issuing a CBDC. Thus, I thought that I could contribute to the discussion today by trying to take stocks of the many issues that are dealt in the book. My bottom line is that issuing a CBDC is a very complex task, and this complexity is well represented in the book. So this is my agenda, basically. I would spend some few minutes trying to talk about why a CBDC, then the key dimension of a project of introducing a CBDC, and then I will say something about digital euros. Why a CBDC? I want to make this point because I see that there is a little bit of confusion in the discussion. Often when we talk about why a CBDC, we all put together all the possible motivation. And indeed, this is not right from my point of view, because we have to distinguish which point of view. Central bank, I think there are at least 4 actors around the table here. Central banks, banking sector, new actors entering the payment space, and individuals. Those stakeholders may have very different point of view. Often they contradict each other. So the first very complexity to solve is to find the set of common goals of CBDC. So the set of requirements CBDC will have has to be such to satisfy the whys of the different groups here. And who knows whether this set is empty. And if it's empty, then we have to come up with some solution. And this might be a very complex and challenge endeavor. So the first level of complexity is to figure out why we need a CBDC. I'm not going to answer this. In many parts of the books, these issues are addressed And so I will just pose the question here. Let me move to the second part of my topic, which is on the key dimensions of the CBDC. I think there are at least 4 dimensions here: legal, economics, technology, and the organizational impact of the issuance of CBDC on the organizational of the central bank. Now, I don't have the time to dig into each of this. Many papers of the book deal with this problem. For example, the Professor Schwartz's paper digs into the legal aspect. Mr. Ali paper digs with technology, and I guess Mr. Cirasino paper talked a little bit about the implication for the central bank. But just the sheer size of the many issues listed here tells you the complexity of this endeavor. And the complexity is not just due to the number of dimensions that need to be kept under control. There is an additional layer of complexity due to the fact that those dimensions are not independent of each other, so that they can be dealt sequentially. Actually, as a matter of fact, many of those dimensions are interconnected and require a simultaneous approach. So the complexity is also on the simultaneity of the problem to be solved. Let me spend a few words on the economy. As I said, I don't have the time to go through all those dimensions. Let me spend a few words on the economics of it. This slide is an attempt to list the many concerns raised around the possible issuance of a CBDC and to broadly group them. Let me start with the issue concerning monetary policy. The first issue is whether there should be a remuneration or not. It has been suggested that a remuneration of the CBDC might increase the speed of the transmission of monetary impulses. First of all, the remuneration issue has a legal implication that we should think about. As for the speed, the fundamental question is whether this is going to increase the impulse of the monetary policy. Another question, fundamental question, is whether this transmission, this speed, this effect is symmetric when you have an increase or a decrease of interest rate, and whether, and in case we use it to say to tight monetary policy, the question is: do we need an additional element, an additional tool to tight monetary policy? And on the contrary, when we want to lose monetary policy, is remuneration for CBDC useful? My guess is that as long as cash is there, the zero lower bound will not be overcome. So one might question whether the remuneration could be a useful tool. There is the question of the volatility of the liquidity of the economy. Since the deposit can be exchanged for CBDC in real time, the liquidity of the system might become harder to forecast, thereby undermining the ability of the central bank to steer short-term interest rate. By the same token, volatility of the exchange rate might increase if no residents are allowed to hold CBDC. And when considering whether to allow non-resident to hold CBDC, one has to evaluate the impact on the monetary system of other countries. Dollarization of a smaller economy, well connected with the one issuing CBDC, is a serious possibility to be taken into account. Many papers in the book deal with this problem. One of them look at this issue from a geopolitical perspective. Another suggests that some international regulatory framework might be needed. Financial stability concern stem from the fact that people may find convenient to replace deposit with CBDC. This could be so because CBDC is a safe asset. This crowding out effect has several consequences. The most worrisome from a financial point of view is when this substitution occurs abruptly because of bank runs. Bank runs will be very easy because they will be just one click away. Banks need to be able to have immediate access to alternative sources of funding. It could be central bank money or other sources. When the substitution takes place over time, it has less dramatic consequences, but no less deep and long-lasting. Central bank balance sheet will expand, onboarding risk previously borne by commercial banks that have the skills to assess and manage them. Even this simple transformation of funding will not be immediate because it requires large amount of collaterals of the quality and quantity required by the central bank. If this collateral is scarce in the economy, tension on the bond market might occur. Just to give you some number, currently €1 of central bank money, for €1 of central bank money, banks have to post about 1.3 euros as collateral. If central bank does not step in directly financing commercial banks, others have to do it with the ensuing issues about cost and stability of funding. There will be some effect for the ability of banks to transform short-term liabilities into long-term financing. In a schematic way here, I linked the effect on the real economy to the shrinking of the asset size of the bank balance sheets. This required the emergence of new entities to finance real economy, maybe even the central bank, and a move toward a move closer to the narrow banking. This long list of worries are recorded in several chapters of the book. However, when you issue CBDC, you might run many risks, but the fundamental question is whether those risks can be managed. And there are 4 points that I wish to dig a little bit upon. Whether the first is what economic theory tells us. The second is whether CBDC is going to replace cash on deposit. The third on whether there are limits and incentives to manage those risks. And finally, whether those risks are particularly large. Let me talk 1 second about the economic theory. First, it is very important to know that under certain conditions, the introduction of a CBDC does not change anything in the real economy, as long as the central bank is willing to lend to commercial banks to make up for the lost deposit. This is a theoretical result shown in a recent paper by Brunnermeier-Niepelt. Whether these conditions are met is a matter of empirical evidence. However, it's very important from a conceptual point of view to know that an equivalent result is possible. Second, it is pretty clear that if CBDC is going to replace cash, it's obvious that nothing is going to change for the banking system as a whole. And just to give you an example, in the euro system, there is a large pool of cash to be replaced. Just to give you a number, this is the consolidated euro system balance sheet. Banknotes represent 1.4 trillion euros. So ample room to substitute. As a matter of fact, cash lending is a relevant cost for banking, and therefore a cash substitution might bring about benefits for banks' profitability. Third, there are ways to incentivize people to demand CBDC as a means of payments rather than store of values. Recently, Fabio Panetta and Ulrich Binzeit have proposed a two-tier remuneration system for CBDC holding. They propose that holding up to 3,000 euros, there is a remuneration scheme which is equivalent to the maximum between 0 and the deposit facility rate minus 2%. So basically is the green line, the green line. This is the facility rate. This is 45-degree lines. So, and this is the scheme for tier 1. And the second tier, which is tier 2, for holding beyond the 3,000 euros, which is the minimum between 0 and the deposit facility rate minus 0.5%. So is this red line. When the DFR is greater than 0, so we are talking here, this space here, banks have a wide space to remunerate deposit at a rate higher than the CBDC and still be profitable. Thus, people choosing to hold CBDC will pay an opportunity cost. This should discourage an excessive use of CBDC. When the DFR is below 0, so we are talking about this area here, there is an incentive for people to replace deposit with CBDC for an amount up to 3,000 euros. This zero bound, though, limit is due to the fact that as long as cash is available, then people can always turn to it. So it's very difficult to go beyond that. Beyond that amount, CBDC offers a remuneration that is lower than the one bank can offer on deposit and still be profitable. It might be worth noting that when DFR is in a negative territory, there is a very loose, there is probably a very loose stance of monetary policy, and likely banks do not suffer from lack of liquidity. A system like this could prevent people from replacing deposit with CBDC in a structural way. It remains to be seen, though, whether a system like this will be effective in case of bank runs. In these extreme events, additional tools may be required. As a matter of fact, even today, in case of bank run, authorities can freeze deposit withdrawals. Fourth, I think our discussion about the risk could benefit from assessment of the possible size of the substitution effect between deposit and CBDC. A recent study, very interesting study by Mediobanca, can provide a first cast to this problem. The study is an interesting accounting exercise of the effect on bank profitability of an issuance of CBDC. In case a remuneration scheme such as Panetta Binzeit is adopted. Here are the assumption of the exercise. The study estimates that there are about 316 million of possible holder accounts for CBDC in the euro area. They are supposed to hold CBDC at the maximum amount allowed under tier 1, that is 3,000 euros each. No one uses tier 2. Therefore, the amount of deposit that is withdrawn and transformed in CBDC is about 950 billions to be replaced. This is about 8.4% of the whole deposit held by household and non-financial corporation in the euro area. So the study compares two alternative scenarios. One in which banks substitute, one in which banks make up for deposit lost by using their liquidity held at the central bank, and the alternative scenario is that banks, because of regulatory requirements, on liquidity make up for the lost deposit by issuing medium to long-term unsecured bond at an average cost of 0.67%. Here are the results. So deposit, as we have seen, deposit declines by almost 1 trillion in both scenarios, obviously. The cost of the funding, actually, in the case bank finance themselves using the liquidity, declines a little bit. The reason being the fact that they don't have to pay anymore the minus 0% remuneration scheme into the deposit facility rate. And therefore, the profitability, net income of the banks actually increase in this case because of they don't have to pay a negative remuneration for the central bank. And the return on equity actually increased by almost 3 basis points. Alternatively, when the banks finance themselves through issuing bonds, the cost of the funding increased a little bit, as you can see, and the net income declined by almost 5 billion, translating into a declines in the return on equity of about 17 basis points. Overall, summing up, as long as CBDC is used as an additional means for general public to carry out the everyday payments, it doesn't seem to represent a threat to the financial stability of the banking system. Obviously, this exercise is based on the current scheme, on the current scenario of loose monetary policy, but would be interesting to carry on a study like this in an environment with higher interest rate. My first guess is that the level of interest rate doesn't really, is not that relevant. What is relevant is the gap, the spread among different interest rate, deposit and bonds. Let me turn to my last point in the presentation, the digital euro. Where do we stand and what people have to say about digital euro? Here is the roadmap. Here is the roadmap for the digital euro. Let me first say that digital euro project is truly a collective effort of ECB and the 19 national central bank of the euro system. We have been working shoulder to shoulder for more than one year on both policy and technical issues. From January 20 to June 2020, we worked at the report that has been published in October with the approval of the Governing Council, who also extended the mandate of the task force to prepare all the necessary information needed for the Governing Council for deciding whether to launch a formal investigation phase of the digital euro project. This decision whether to launch the investigation phase will be taken in June. Therefore, since October, we have worked on several tasks, running a public consultation whose result have been published on April 14, preparing a detailed work plan for the investigation phase should the Governing Council decide to go on. So we worked on the governance, on the sourcing, on the technical work stream. And we spent some time in exploring possible technical solutions for digital euros. This part of the job has almost been completed, and we are about ready to submit all this material to the Governing Council to decide whether or not to launch the investigation phase. This should last at least 2 years, or more or less 2 years. It could be concluded with the development of a minimum viable product. A new decision of the Governing Council will be needed to move ahead with the testing. The overall project might last another 4 to 5 years. So here, the last point I want to make is just to share with you some of the result of the consultation we ran since from October to January, and we published a report on it last week on the 14th. So The public consultation was a great success, according to the level of participation we have seen in previous consultation. So we got more than 8,000 answers, coming mostly from Germany, Italy, and France. What do people want from the digital euros? Well, certainly privacy is an important issue. So people want to preserve one of the main amenity of the cash, which is the privacy of the payments. Finally, so despite all this attention on the privacy, people are concerned to avoid so that they want to avoid illicit activity. Security and the usability of the euro throughout the whole area is ranked highest at the absence of, and they would like to use it offline. Let me, since I take too much of your time, let me stop here. Thank you very much.
Thank you very much. It's such a privilege and responsibility to take the floor after the Deputy Governor, Mr. Cipollone. Thank you again for such an inspiring speech. Let me thank again all our panelists and colleagues from the Bank of Italy and Intesa Sanpaolo who have contributed to this research effort. We have a dense agenda ahead of us, and I don't want to steal too much time from our great speakers who will tackle the contents of the volume. Very briefly, I would like to spend 2 words on how and why we have envisioned, together with my colleagues Fabrizio Botti and Franco Passacantando, this research project. Since 2019, we have put an effort in investigating the digitalization of finance. This phenomenon has crucial implications that extend well beyond the banking system, with potential effects on the functioning of our society and of our economy. The first step of this approach was the research effort of big tech finance, resulted in the volume, The Rise of Tech Giants, a Game Changer in Global Finance and Politics. This volume represents the second step. CBDCs are just a piece of the puzzle of transformations driven by the digitalization of our society. As we will explore during the roundtables, the implementation of CBDCs would not simply mean to replace bills and coins with virtual cash. This innovation could produce major changes in our economy and society. With this approach, together with the authors, we have tackled some of these major aspects with considerations ranging from the ethics of payment and financial system to the impact on regulation and privacy, from national and regional cases to the call for international coordination. We are still in a phase in which central banks are studying, analyzing, and experimenting around the implementation of this innovative but potentially disruptive tool. Contributing to the current debate on what CBDCs are and of their economic and political dimension, thus become crucial to ensure that the introduction of CBDCs will help to improve the economy as well as to achieve a more inclusive society. I leave you with an open question, which I keep asking myself. After big tech finance and CBDCs, which will be the next key transformation that digitalized finance will produce? Now I leave the floor to my colleague and friend Silvia Pavoni, economics editor at the Banker Financial Times, who is going to chair the two roundtables. Let me thank again all our panelists, Mr. Cipollone, Ambassador Nelly Feroci, and Franco Passacantando, and Fabrizio Botti. Thank you very much.
Thank you. Thank you, Nicola, and hello, everyone. So it's a pleasure to join this discussion, sadly, from London rather than Rome, as it did happen in the past. Nonetheless, I'm sure we're going to have a lively debate, even if not face-to-face. So let me introduce you really briefly the panelists that we're going to hear from for the first roundtable. We have Ali Roble, who is the founder of Wadaxco. We have Massimo Cirasino, a global independent advisor on payment and system matters. We also have Claude Lopez, who is head of the research department at the Milken Institute. And last but certainly not least, we have Stephen Schwartz, and I hope I pronounced his surname correctly, who is a distinguished professor of law and business at Duke University. Welcome, everyone. So let's get straight into it. And the first question I would like to ask to Mr. Cirasino, and I'm going to address all of you by your first name, actually, if you don't mind. So we're going to have a bit of an international approach to things rather than a traditionally more formal Italian style. So, I'll go first to you, and I hope we have Massimo connected. Yes, we do. Hello, Massimo, and welcome. Let's go back to the beginning. Of course, the reasons behind the introduction of CBDC has been tackled in the previous presentation, but from your point of view, why do central banks need or should look at this alternative, at CBDCs?
Thank you, Silvia, and good afternoon, good morning, everybody. And yeah, allow me just to thank the Istituto Affari Internazionali as well for this webinar, and also, of course, for inviting me to participate in this study, and particularly Nico, Fabrizio, and Franco, but all the other partners in crime with whom we have worked hard to put together some food for thought. And I think, you know, the first interventions have really clarified that there is a lot to be discussed in this area. I will be short, but allow me to just put a couple of basic facts on the table. And my experience is that they are almost always forgotten. I should clarify that I have been working for over 20 years at the World Bank, and my experience has been in reforming payment and settlement systems and services around the world. I think I have the record of exposure to countries, over 100 countries, several interventions. So I have a very diverse, let's say, experience. And when I speak, it's hard for me to talk about a specific country case or use case. So I will try to generalize, but I think this particular topic of CBDC applies to almost every country, independent of their stage of development in the financial sector. And the basic facts I wanted to remind all of us of are, one, the central bank is already, in most countries, the largest payment service provider through the use of cash. Cash, is many economists, represents by far the most used payment instrument in volume. This is not true everywhere, but it is true globally. And that is a fact that we cannot ignore when we look at how CBDC can introduce changes into the way we do business, as some of the previous speakers have already mentioned some of the numbers. The other one fact, which is probably the most important one on which I'm going to focus, and I apologize if I'm going to be a little bit inelegant, certainly not in Italian style, but again, I've worked most of my career outside Italy, and in particular in the United States. So in the US, this would be tolerable. And in a CNN debate, when I was asked about the state of affairs, about the global payment system, so basically supporting cross-border payments, I used two words which actually gave me some popularity, although I realized immediately they were not too elegant. And I said, it sucks. Really, the global payment system doesn't work. And the domestic payment system, what we call national payment system, doesn't work in the vast majority of the countries that I have visited, or doesn't work with the same level of efficiency and in some cases safety that we would like to see as overseers, and in particular central banks. And so I think everything we discuss in terms of payment system reforms starts from that perspective. I mean, something has to be done, even if in the last 10 years, we have heard several people talking about the benefits of fintech, technology, and the beauty of new players, telcos, and everybody has come with a new player that should have changed the landscape of the payment system. But so far, we have seen, let's say, very limited changes, although we see some promising events coming up, for example, in the field of fast payments. So that is where I believe from a payments perspective, and in particular in central countries where the level of innovation in digital payments is still lagging behind. The role of the central bank as overseer, but also as provider of critical payment services is going to be crucial. And possibly CBDC would be one of the answers to this problem. I'm not going to advocate CBDC for every country, for sure. So that is to be fair. But there are important advantages from a payment system perspective. There are also potential risks that, in my opinion, can be managed, some of which have already been identified. Potential disintermediation is one. Potential reputation risk for the central bank if things don't work well is another one, in particular in certain countries that cannot be ignored, where fundamental infrastructure that should support CBDC, like energy, telecommunication, might not work equally well in all parts of the country. I think that would be a consideration that should be taken into account. But again, those things can be possibly managed. And what is important to have to conclude this first intervention is a mindset for a decision-making process that could take into account several of those questions that we can ask ourselves. And with colleagues at the World Bank, we are about to publish some of the content is already in the book that you have seen from IAI. We're about to publish a framework around 5 fundamental W's. So basically it's the why, which we have discussed a little bit already, the what, so what model should be chosen, the when, which is very important. When would a country embark into a project like that? Where, meaning what is the underlying infrastructure that should be used, and why, and who. So who are the players that should be invited to have a role in this model?
That's great.
And this is just to finish, to have a big, to answer the first, the big W, which is whether, should we do it or not? Mm-hmm. And maybe we can say no to that question after we have identified all these other elements to discuss. So with that, I finished this first round, and I hope I've been able to stay within the time allocation. Thank you.
Thank you. Thank you for sharing this blueprint for what we need to look out for and on which to base potentially CBDCs. Let me go to Roble. So Roble, how do you envision a system centered on these currencies, and would it be more efficient if we were to decide to go down that route?
Yeah, I mean, I think that's one of the attractions of doing a central bank digital currency is this idea of, I mean, I think one important point to get across is central banks and the financial system are always changing. So, for example, my former employer, the Bank of England, was founded in 1694, and the financial system in 1694 is not what it is in 2021, right? And obviously the Bank of England has changed over those 300 plus years. And I think that when we think about central bank digital currency and research into it, we have to put it in that context of a changing financial system. And I think that often people talk about the risks of central bank digital currency, how it's designed, etc. But I think that we have to also think about, like, what's the risk of not doing it? And I think that's something that people have thought about increasingly in the past 18 months, I guess. And that's driven, I think, a lot of the work. Because if you don't do anything, then something will fill that vacuum, and it may be that the central banks don't like that something. In terms of efficiency, yeah, I mean, I think that one of the big attractions, this is not a traditional remit, sort of necessarily competition of central banks, but I think that if you have this sort of open, neutral platform that, you know, other technology players can build on top of, it gives you greater competition. I think that really drives greater efficiency. And I think also, you know, some of the features that we have or that we can see developing in the world of digital currencies, private digital currencies, you can take some of those features and attach them to a central bank digital currency from a design perspective. The attractive ones, I mean, I think there are some things that you wouldn't choose, like proof of work, for example, but there are other things like programmability to a certain extent that you would, in those technical features give you the possibility for much greater efficiency. And I think in the future, when we think about not just central bank digital currency, but artificial intelligence and how that's going to change the financial system, all these things fit together. And I think creating a central bank digital currency or working on a central bank digital currency gives central banks really good insights into how the rest of the financial system could and should work.
Thank you, Rob. Very, very interesting points that you mentioned there. So we talked about whether we should look into this, whether the CBDCs may improve efficiency and the cost of not looking into potentially developing them. And so now I would like to hear from Stephen and hear whether regulation also needs to adapt. And if he manages also to squeeze in a comment about regulation when it comes to cross-border retail CBDC payments.
Sure, thank you. Let me try to put this into a simplified perspective. We're talking about digital currencies. On a wholesale basis, financial institution to other financial institutions or to businesses, we already pretty much use a digital currency system. It's set up whereby if I'm a company, I'll order my bank to pay another company's bank for that other company's account. I think the legal challenge at this point is to adapt that to a retail basis, a retail digital currency. And that really, from a legal standpoint, that's going to raise two questions, or it's going to have a decision tree that could go two ways. One would be, should we do an account-based retail digital currency, or should we do a token-based retail digital currency? And at least in the United States, and in a recent talk I gave at the Bank for International Settlements, I gather that in Europe, there is a great leaning towards starting with an account-based digital currency because it would essentially piggyback off of the technology that is used to transfer funds electronically among financial institutions. Another question is, should we do that through the existing retail account system or in some other way? And I think that at least initially, there is some view that we should use the existing commercial banks to try to minimize the so-called disintermediation that others have mentioned, the squeezing out of low-cost deposits to commercial banks, thereby potentially increasing the cost of bank loans. The last point I should mention, well, maybe the last point, is when you adapt all this wholesale technology to the retail sector, what regulation needs to be added? And I think generally there are two areas. One is consumer protection legislation, and the other area is in terms of anti-money laundering, something like the Know Your Customer rule. If you have very large transfers, it's much easier to know your customer than if you're talking about individuals transferring small amounts. The last point, Sylvia, that you raised is in terms of international. And I think in terms of a central bank digital currency, the central banks will work together internationally as they do now in terms of the Basel capital adequacy requirements. The idea would be to try to talk to each other, and this discussion is going on. I think in terms of cross-border, the much greater issue is going to be the competing or the competition with a central bank digital currency, the so-called global stable coins that are sponsored by private companies. And if there's more time, I'll talk about that. But if there's not, I won't. Thank you.
Thank you so much, Stephen. Thank you also for keeping to your answer nice and short as others have done. Claude, so I would like to bring you in the conversation. We heard from Stephen about regulation. Of course, there is a lot to be said about supervision as well, and global supervision. Mm-hmm. What are your thoughts?
So yeah, whenever most of the discussion that we had so far was very much at the generator levels. That means within a country, within one specific platform. The beauty of digitalization is make, as we said, cross-border transaction more effective. And so one can totally imagine a world where there will be more than one CBDC, and actually in a cohabitation with some private ones. And what will mean success is the fact that there is an interoperability. So the goal of CBDC is what? Digitalization make transaction easier. Everything become more consumer centered. The success of such a tool, whether it's from central bank or the private, will be a broader application. Probability for one platform to cover the world is very low, as we know. However, what we have, or what the central bank should have, is an incentive to make sure that their job is the fact that to facilitate transaction across a lot of different platforms, especially during this transition period. As we discussed, I mean, we talk a lot about regulation regarding the system that we're in. And I think there is a consensus that tomorrow will be extremely different. And how can we make sure that that transition remain relatively stable? And so that's why whenever in that piece I talk about interoperability and also the necessity for a global coordination or a global framework to at least monitor and set some technical standards regarding what is a CBDCs. There will be different types, or can you recognize? This transparency will allow for the user to be quite comfortable, and then that will also allow interoperability with all what will come with if you have standardization of some some aspect, and also the implementation that will allow monitoring of the risk, which is one of the big issues that we have, especially whenever we want to make sure that digitalization and technology fit its purpose of financial inclusion, improvement of a lot of things. You need to make sure that the risk is not overshadowing all those things. And one last thing, coordination is very important because we also saw that a lot of innovation in that field come from less developed countries. Okay, so they absolutely should be part of the discussion when there will be an effort, or if there should be an effort to actually have a standardization.
Thank you so much. Thank you so much. And sadly, the time has gone really, really quickly. And I could see that there were a few questions that came through the Q&A function, some of which have been replied to already online. There was one that we are going to tackle in the next roundtable, but I also would like to put it really quickly if the panelists manage to give me like a 30 seconds, 1 minute answer, which has to do, so we introduce a subject again that we're going to tackle in the next panel, the issue of privacy. So how we feel about protecting privacy potentially at the expense of information that could help combat illicit operation. So where do we stand on finding, how are we going to find that balance? And let's see, if you can just raise your hand, physically raise your hand, I can see who would like to close.
Well, you first have to define what will be privacy in the context, especially in the context of a currency based by the central bank. It's very different from the current discussion that we have about privacy of individuals. So it's about transaction. And actually, I think that one of the key questions at the core of CBDC, can the central bank have access to all that information while cash is pretty much, privacy is very much preserved. But at the end, it's all about governance of data and how do you want to share it and making sure that you know what goal you're trying to achieve.
Mm-hmm. So we go back to regulation, I guess, in that case. So unless there is, yeah, of course. So unless there is there are any other comments from anyone else on the panel on this specific point, sadly, we'll just have to thank all of you for sharing your thoughts in such a succinct and very interesting way. It's been a very quick, I feel, but informative discussion. And I encourage the audience, of course, to perhaps through the IAA to, if they have any other questions, I would like to keep in touch with you to ask and be connected through you so that this can really be an ongoing conversation with everyone. So thanks again to all participants. And I think now it's time to move on to our next panel discussion. Let me introduce you to our next set of panelists. We're going to talk about sort of more national and regional experiences when it comes to CBDCs. We have three panelists. Jan Kerich, who is a senior lecturer at King's College. We also have Tim Mazela, who is head of the National Payment System Department at the South African Reserve Bank. And we have Franco Passacantando, who is a scientific advisor at the AIA and the interim chairman of Euroclear. Welcome to everyone. So I hope I have all of you here available online so that we can start the discussion. So let me go first to Franco, if he's indeed online.
Yes.
Franco.
Hello. Yes.
Yeah,
okay.
Hello. Good to see you, Franco. So let's start with you, and let's keep on talking about the issue of privacy that we started discussing in the previous panel. Why do you stand on this?
No, I mean, let me clearly say that the issue of privacy, as it appeared clearly in the consultation that the ECB just completed, is the top concern of the public. And so it's clearly the most important issue that has to be addressed in designing this currency, if it will ever be introduced. At the same time, it was interesting to note that most respondents also consider that the need to prevent illegal activities. So there is a possibility of finding a solution that can be technical, depending on what type of technology you use, that can preserve confidentiality and at the same time make sure that illegal activities are not encouraged. But let me, if I have 2 minutes, and I will be short so that people will be interested in reading the chapter and the book as a whole. 2 minutes just to explain what I see as the main challenges in Europe, because Europe has a lot to gain in introducing a digital currency on one aspect, but also lots of problems to solve. The opportunities derive from the fact that in Europe, we have a very innovative system, very innovative solutions, but first of all, they're still fragmented at national level. You don't have a common application app to pay instantly all over Europe. You have to go to change your app wherever you go, contrary to other jurisdictions. Europe is also a very dynamic and very advanced system, both in the private sector and the public sector, in the era of large market infrastructures and also wholesale payments. The main market infrastructure, private market infrastructure, but also the ECB with the T2 and T2S, less on the retail front in terms of common initiatives. So there is a room to intervene in that area, and it's something basically that cannot be left mainly to the competitors coming from large tech companies. So basically, I think that Europe, the option of not doing anything is not an option. But what are the risks? Okay, first of all, it has been repeatedly mentioned, the risk of the bank disintermediation. As Piero Cipollone mentioned, it is really not a big issue if properly managed, the quantitative limits of the currency. And I would, in what I wrote, I even go beyond and say that to a certain extent, it can also be an opportunity, because in Europe, we have a largely bank-based financial system. if we create an incentive for banks to use more capital markets, that could also be an opportunity to improve the overall financial system. Of course, the capital markets union has to be completed, and Europe is behind on capital markets union. I see more issues with financial stability because whenever there is a financial stability problem in Europe, it tends to affect some countries more than others. And again, if the digital euro has to improve the overall system, it has to be accompanied by completion of banking union. But the main risk that I see is that it will not be successful. Why? Because in countries where people like cash, and Italy is one of them, people will probably continue to use cash. And in countries like Netherlands, where they're already very sophisticated and they use very advanced instruments, they will not abandon those advanced instruments to go to this. So it is important that the new instruments, first of all, complements the initiatives of the private sector so that these instruments can also offer the value-added service that the private sector is already. And then it's simple, easy to use, so that also the people who use cash will be using. Thank you.
Thank you, Franco. So let's see whether there is going to be perhaps a faster take-up of digital payments, even in places where cash tends to be the preferred route. Tim, I'm going to come to you and bring you into the discussion. So obviously, as I said, you are part of the South African Central Bank, and Africa as a continent in general has had quite interesting experiences when it comes to mobile payments. There was also a question, so I'm going to link it into what I was going to ask you about financial inclusion and how CBDCs can actually perhaps help or the impact that they may have when it comes to financial inclusion. So thanks for the person that put forward that question. So in your experience, how can CBDCs actually, what is the impact that they can have when it comes not only to development, to economic development, but also to financial inclusion, and of course the two are in a way related.
Thanks. Indeed, thanks for inviting me to the session, and indeed for us to share the perspectives from the African continent. As you know, we actually striving to ensure that the underserved and the excluded in our own communities are included and they have access to financial services. And in this quest, we actually moving from a position where we're saying perhaps notes and coins in terms of cash are cumbersome to manage. And if we come up with innovative electronic means of which CBDC could fill one of the voids, we could be going a long way to ensure that the underserved are indeed enabled access to financial services. One, in this respect, the starting point is we would like to have the ubiquity of the usage of these electronic means. If we put these instruments in the hands of the people, but we find that the acquiring infrastructure or the acceptance is not there, we're not going to do it. And in this regard, as colleagues on the call could be aware, we have the M-Pesa example in the Kenya-Tanzania region, where the systems were not developed, and mainly there was high usage of cash, and the mobile instrument revolutionized things in that environment. And it went close to offering a peer-to-peer exchange where wallets could be opened using the telco Vodafone in that instance, where people were able to exchange value. And what was great about that was that even the informal traders were able to accept electronic payments. Now, we're saying financial inclusion should not end with payment for services, but it should advance more in the store of value so that people can keep value for when they would like to utilize it, access to other services relating to insurance, access to finance and others. Now, in your question of privacy, we finding that in our view, the privacy should talk to the information about transactions being accessible to parties that need to know. Because when we talk to access to loans and finance, you need a track record of sorts so that at least you could be availed other products going forward. So we don't support pure in an anonymity, but we support privacy such that the information about transactions is kept for those people that need to have access with the consent of the consumer for the benefit of the consumer. So in terms of your question, our financial inclusion talks to transacting, access to financial services like insurance and finance in terms of loans and others. And in that context, we feel the people will be mainly included in the system rather than only being able to transact.
Thank you, Tim. You mentioned a couple of really interesting and successful experiences. It would be fascinating to see how CBDCs may develop across the continent. Thank you again so much. Jan, I would like to go to you and ask you about the impact that digital currencies can have when it comes to internationalization. So, for example, thinking about the yuan, would a digital yuan be a more international yuan?
So the answer is a little bit. I think so. Obviously, China is one of the first countries, or one of the leading countries in bringing out a central bank digital currency. It has already tested both domestically recent. It's tried to test cross-border with Hong Kong. So it's quite advanced in this area. And you can say that the launch of the central bank digital currency, or DCEP as it's called in China, will be one of a package of initiatives that China is having to internationalize the renminbi. So there are others that it has done over the past 10 years, such as currency swap arrangements, renminbi centers, and so on. And so this is part of this package, but there are various limitations. So, you know, the renminbi is still not such an important currency internationally. In global payments as a reserve currency, as an investment currency. So, and the central bank digital currency is unlikely to change this massively. Where it can be quite promising, so that's what I developed in the chapter, is that, you know, as it simplifies, it can simplify. If it works cross-border, which is the technological question again, and not only technological, but there are other aspects. If it works cross-border, it could simplify transactions and you know, help replace things like SWIFT, systems like SWIFT, and make transactions cheaper, in particular for people engaged in international trade, who are quite, you know, China's the largest trading nation as well, but also, you know, supporting Chinese tourists, being used by Chinese tourists when they go abroad. So in these kinds of areas, it is promising and it can help the renminbi. But the issue is, you know, will people start using it as an investment currency more, or as a reserve currency? Governments, will they use it more as a reserve currency? And here it's much more difficult. And given weaknesses still in China's financial system, the fact that China's capital account is quite one of the closest ones in the world, so it still has to do all these reforms domestically. And, you know, DCEP doesn't change the need for these domestic reforms and for this financial liberalization. So in a sense, it's one step in internationalizing the renminbi further, shifting the world payment system a bit more towards the renminbi, but there are lots of other things that would need to happen as well.
Thank you. So let me bring in also a question from the audience, which picks up on something that was mentioned earlier on in the webinar, which is the issue potentially of competition with private sector, with digital currencies originated in the private sector. And talking about internationalization of currencies, of course, one has to wonder whether a digital currency by a big multinational private sector platform, Amazon, Facebook, may end up being more successful, may end up actually competing with what a central bank digital currency may want to achieve. So to all the panelists, how do you see this as a potential tension or as a complementary element of digital currencies in general?
I see this as a potential synergy meaning like 1 + 1 equals more than 2. You have private companies, first of all, their ability to have a successful global digital currency, a global stablecoin, will depend upon ensuring the redemption of the stablecoin for the underlying reference asset. And there are 3 basic ways to do that. One is by getting derivatives to insure it, and that's very expensive, even if you have the market. Another is by collateralizing it, which is very expensive. Another is by doing managed reserves, which is what Facebook is considering for the Libra. But you could have, for example, strategic public-private partnerships. So if you have, for example, a global stablecoin that is redeemable for a fiat currency, the central bank issuing that fiat currency could engage in a partnership. And these types of public-private partnerships are very common in the US and in many other countries. And you know, what would happen is that the issuer of the stablecoin get the benefit of the central bank's guarantee. The central bank would get the benefit of perhaps being paid fees by the issuer of the stablecoin. And you know, potentially, you also could have the central bank gaining some degree of control over the issuance, which can basically control the amount of public and private currencies to keep the central bank's control over monetary policy.
Thank you, Stephen. Very interesting points. What do the other panelists feel?
May I just say that we have to be a little bit humble in this and say that we actually don't know what is going to happen, that there are several initiatives. We were all surprised by the incredible appeal of cryptocurrencies and by some stable coins like Tether, and the initiatives of, as we heard in China, that maybe, so there are, it is a moment in which several initiatives will probably change the global landscape. And it's important to be present. It's important to be in this game that is going to change the way the monetary system works. And that's why every jurisdiction should be part of a cooperation in understanding what will happen. But at the same time, you know, it is a new territory, and we have to really be humble and understand that we have to be present, but we don't know yet where we are going.
Thank you, Franco. But I think everyone here feels that this is definitely something that is here to stay and that has the potential to revolutionize the financial system, which is a fascinating subject. So we still have just a couple of minutes. We managed actually, and I have to thank all the panelists for managing to be so succinct in their remarks, so we will be able to finish pretty much on time. But we do have a couple of minutes, so let's see whether the audience has the digital audience has any questions, and I saw a few coming in that we have addressed either directly online or through our panelists. Otherwise, I will just keep on asking about again the different experiences at a national, regional level, and what's and the kind of dialogue that can open actually between these jurisdictions based again on their experience, but also based on the fact that we've been hearing and talking and advocating, many have, for a global harmonization when it comes to regulation, sadly failing most of the time. But perhaps do we feel that when it comes to digital currencies, because of the very nature, this is really where the different regulators can actually come together and agree on sort of global outlooks and global rules? Or is it still too optimistic? And I can see Jan kind of smiling.
I don't know if I'm the best on the panel to answer this. But I'm not sure. I mean, for China, I can speak for China, and I think for China, pushing this, they see it as a chance to at least have a say, or not have a head start necessarily, but have a say in the future of regulations and rules that might come up, and standards that might come up in this area. And we talked about privacy a lot, so I don't know how, in China, for example, in this area, there's less of a concern. So it could be that the sort of standards that people are thinking about in Europe are very different ones. So I could see that as potential. There would be needs for discussion or compromise.
So there may be a potential mismatch there. And also, obviously, a point that is important to make is that these currencies, when again talking about the internationalization of currencies, can have, in a way, a sort of geopolitical side to them. Tim?
Yes, from our side, we actually looking at the global or cross-border element and how we can solve the frictions in cross-border payments. And in that quest, based on your question, we would believe that collaboration and cooperation at a global level or cross borders would be very useful, because we could put our minds together to try and address some of the frictions relating to the long chains of payments and the issues that are relating to the exchange conversions that are cumbersome. And in that respect, we could perhaps benefit quite a lot in that respect. Thank you.
Thank you, Tim. And I'm tempted to also ask Stephen, who very kindly stayed online and visible for his thoughts.
Well, again, I would go back and say that central banks traditionally, at least for decades, have been working together when there are issues that cross borders. And I think they will continue to do that. What will be, I think, more interesting is if you have a myriad issuers of privately issued global stablecoins, how those laws are to be harmonized. One of the great frictions in terms of cross-border currency transfers is the multiplicity of laws and how to harmonize them. And I'm currently working with the others on trying to come up with some sort of at least initial potential model law that might suggest fundamental principles for global stablecoins to adhere to. And those principles arguably should also have application to central bank digital currencies.
Thank you, Stephen. I can see there is yet another question that came through. So if the organizers don't mind, let's try and address it. And if the panelists from the previous panel are also still with us, feel free to join in and volunteer to comment on this. The question is whether these digital currencies could be used as an instrument to become the ultimate weapon for monetary policy in the hands of central banks, and if this gives special powers to policymakers. So if they can enhance the role of central bankers and really help with monetary policy and quantitative easing as well within the EU. So I'm not sure whether this is something that's our panelists would like to comment on, and if not, and again, we're just going to use a really old-fashioned way of physically raising your hand if you'd like to comment on this. Otherwise, perhaps we'll address that question separately. But to wrap up, perhaps we've been talking about again the power of these digital currencies when it comes to internationalization of currencies, to the role that central banks can play in sustaining developing the financial system. But I would like to go back to something that we mentioned earlier, which is financial inclusion, because ultimately, of course, particularly in areas where there is quite a lot of developmental growth that's countries and central banks, of course, also would like to see whether these digital currencies can actually help meet those goals. So if anyone would like to share a final, very brief comment on the role that they can play when it comes to financial inclusion?
Well, the one thing, I mean, account-based digital currencies means you have to have an account. And in some countries, even in the United States, not everyone has a bank account. You might be too poor, you might be too distant physically from the bank. So a tokenized digital currency, whether central bank-based or privately based stablecoin, would facilitate financial inclusion.
Thank you. So it's a thumbs up when it comes to financial inclusion from you. Let's see whether anyone else would like. I see that Massimo has unmuted himself.
Yes, I mean, I've been chairing several international groups on financial inclusion and payment systems. So let me tell you that the only way this can facilitate financial inclusion is if central banks understand that if they issue a CBDC, it should be available universally and make it happen. If they don't internalize that, then there is no way this is going to help financial inclusion. It can help bring central banks into the scene because they are the only institution in most countries that can lead, the financial inclusion agenda, so to speak, because so many other government agencies don't have the capacity or holistic view to do it. And so if central banks can motivate themselves, to do it also through CBDC, that would be great. If they don't internalize that, it would add to the problem.
It will add to the problem. Okay, so
yeah, it's not a panacea per se. That's what I'm saying. I mean, and certainly, I mean, we don't have time to go into token-based versus account-based, but those that believe that account-based CBDC for retail is going to be anything different from what we have now in the private sector, I don't think they have fully understood how the model works.
Oh, you're leaving us just with something so controversial, which I would love to spend time on, but it's right at the end. And sadly, I think we will have to wrap up our session and the whole webinar. So thank you again so much to everyone for your, again, ability to convey such complex and interesting subjects in a succinct way. We managed to kind of stay on time and I hope you enjoyed the conversation. I certainly have. And now I just would like to leave the virtual stage to Paola Papanicolaou, who is the Head of Innovation at Intesa Sanpaolo. Thank you all.
Thank you, Silvia. Good afternoon, everybody. So first of all, I would like to thank again Istituto Affari Internazionali. It has been an extremely interesting conversation. And as a wrap up, I would try to focus on some key concepts and key words to summarize. So the first thing is reality. I would say the digital currency is a reality. And of course, it is also a huge opportunity. We had the numbers that President Nelly Feroci gave at the beginning. So 86% of the banks, the central banks are looking into it. 60% are experimenting the digital currency and 14% are deploying it. The other key word is involvement. So to be a successful process, we need to involve all the relevant actors and counterparties, as Mr. Cipollone was mentioning. And it is fundamental as well that we create a global regulatory framework to also coordinate the entire ecosystem and especially balancing, let's say, the CBDC as well as the private digital currencies as well. And this is also fundamental to preserve financial stability. The other key word is the conditions, to create the conditions to have a mutual interest for everybody. So we understood there is lots of counterparties involved, and it is fundamental to create those mutual interests to foster the digital currencies. Last but not least, I would say technology and of course security, which is key also to provide the privacy that we've heard that most of the individuals are asking for. So maybe to have this as a successful opportunity, it is fundamental to have the right mindset and to create the conditions for a very strong cooperation between the parties. This on my side, so thank you all. I would like to give again the word to the organizers to close.
If I may, before closing, I'm not pretending to draw conclusions. I simply want to thank all participants in this webinar. It's been extremely interesting. A special word of thanks to Banca Intesa, our partner in this endeavor. And also let me express the hope that we will have an opportunity in the future to come back on the subject. I think that there is a need to explore more the future of digital currencies. Thank you very much.